Welcome back, traders. Now, in today's video, we are breaking down one of the most powerful confirmation tools that actually we use in the BTMM method, and that is what we call the TDI divergence. Now, I know many people have actually been stuck around this whole issue, and probably they still haven't figured out how exactly to apply it when they're trading. So if you've ever struggled confirming a reversal, or if you weren't sure the dealer's manipulation was real, this is the video for you. So let's get into it. Hang around. I'll have a few examples at the end so that I'm able to illustrate how actually we get to apply the TDI divergence. All right, let's get into it. So what is TDI divergence? Okay. The TDI divergence in BTMM is actually a tool, a secret confirmation that you could actually be missing if you're not using. Now, TDI stands for Traders Dynamic Index. Okay, it's usually a blend of RSI, moving averages, and volatility bands. All right, or volatility, we can say. Now, divergence is actually a situation where price makes a high or a low in case the trend is bearish, but the TDI green RSI line does not follow or does not make that particular high or low. That means it's lagging or it's not agreeing with the price. Now, that specific disagreement between the price and momentum is your clue that the dealer's push is actually fake. And that, in other words, means that a reversal is coming. Why does divergence matter in the BTMM method? Okay. Now, it's a good question to ask yourself, but if you answer it wrongly, again, you will still find yourself struggling to use it properly. So this is where it gets important for BTMM traders. And by the way, if the dealer moves the market in 3 levels before reversing, then you want to know exactly where he's going to reverse. Now, this is where it gets important for us as BTMM traders. The dealer moves the market in 3 levels before reversing. It could be 3 levels, 3 days, or 3 pushes. All right. But now, what matters most is that the third level is usually the trap or the final push. Okay. And this is where the price will spike aggressively in one direction. If the trend has been bullish at level 3, the dealer is so aggressive to amass so much orders or so much liquidity so that now he can push or reverse the price to a downward market. All right. So at this level 3, stop hunts will occur. You will see big aggressive vector candles out of Asian box or out of session, right? And then traders get baited in. The moment you notice that the market is moving aggressively in one direction, there's always that temptation that actually spikes the retail market into executing orders. Now that is where they get baited. But if you understand how to use the TDI, it will actually expose that lie and you'll be able to react in the right manner. Okay? So if the price makes a higher high or a lower low, but the TDI refuses to follow, or it doesn't create that particular low or high in the market, that's your signal that the dealer is done accumulating liquidity. He's done pushing the price to the upside or to the downside. All right. So the fake move is actually happening when you see those vector candles, those big volume candles out of Asian session, out Asian range, or particular specific zones. If the price makes a higher high or a lower low, but the TDI refuses to follow or does not actually print that particular high or low, then that's your signal that the dealer is done accumulating. And that's a fake move happening right at that moment. And so what you will now be expecting is a reversal, which is actually near or just around the corner. Okay? Now, how do you spot TDI divergence in the BTMM method? Okay, so we're just gonna go through the breakdown of what you need to do to be able to identify a proper divergence. So number one is you need to identify a stop hunt. Okay, and a stop hunt is a situation where you are looking for the dealer to push the price above the previous high or below the previous low. If the dealer has been pushing the price up, for instance, it goes up, goes up, goes up, and then it creates this high. What you anticipate is that he's going to again, after making a pullback, aggressively push above this particular high. And then he is going to bring the price back probably and then start selling off. If it was bearish, he goes down, goes down, goes down. He has created this particular low, then he pulls back. Then he aggressively goes below it, all right? And then he brings the price back. But now that is your step number one. You will usually see a wick or a sharp spike. It could be one candle, vector candle to the downside, followed by a arrow track, okay? And he closes above again. Or if he goes upside like this, and then he brings it down to close the price right at the opening of this candle or below it. Okay, so at that moment when you have that kind of behavior, you want to go to the TDI and you will need to check the green line, which is what we call the price line. Now, you will notice as the price was making a new high or a new low, the TDI makes a lower high or a higher low, okay, depending on the price. So assuming the trend was bullish like this, and then after he makes this pullback, the dealer aggressively pushes and creates a new high. But on the TDI, you get actually something like this. So as the dealer was busy making this particular new high, the TDI was telling you, we are not falling for that move. It's not real, right? And so this here means that this move here was a stop hunt or a manipulation, all right? And it was to grab liquidity in preparation for a reversal. Okay, we are going to look at how that would look like on the chart. Now, if the price makes a new low, assuming the dealer's trend was bearish like this, and then once he makes this new low, he aggressively sells off past that level with vector candles or spikes to the low. And then you will notice as he makes this particular new low, the TDI creates something like this, okay? The TDI creates something like this. So price made a new low right here, but the TDI makes a new high, right? Meaning that this move here was not real. The TDI is not falling for it, okay? Now that is what we are calling a divergence. Specifically, this divergence I'm talking about is what we call a regular divergence, which is common at the point the market is reversing, mostly level 3. Peak formation low, peak formation high. This is the kind of situation you will be expecting to see when you're looking for a reversal. Now, that is what we call divergence. Step number 3 is you look for the 50 EMA relationship. As this situation here was developing, all right, near the 50 EMA or after the third level push, after the dealer has made this level, all right, so you have your level 1, you have your level 2, you have your level 3, but then you see this aggressive push, then that means that the reversal, all right, is even more powerful. It's more likely, it's imminent, in other words. All right. So wait for the TDI cross where you get the green line to cross above the red line, something like this. All right. And then after divergence confirms the reversal phase. And this here would confirm your entry to take the market upward. All right. So I want us to go on to the chart and have a few examples of how the divergence usually looks like and how it works in the market, okay, when you're analyzing the market using the BTMM method. All right. Now, with me here is a CHF JPY chart on 1 hour time frame, okay? Now, what you will notice is that actually for the past 1 week, the pair has been actually very bullish. But then on Friday, we had a situation. So if you look at what happened between here and here, you will notice that from this high, which was formed right here, right, the TDI was not making any new highs, but the price was making several new highs. So it made this one, broke it, made this one, broke it. But then at this point, something happened. So we had as what we call shortened second leg M formation right at New York session. And that's where now we were shorting the market. Okay. Now, what you will notice is this here is a situation where the TDI is saying, I do not agree with what the price is doing right now. So expect a reversal. So at the point we got this reversal, the price, or rather the price line, had already given some sort of a pattern, while the price also gave us an M formation, which now was a trigger for us to go short on Friday. Now, that is just one example. I want us to look at another one so that you're able to see how exactly it usually appears or looks like on the chart. Now, here I have a Euro CHF chart, okay? Still in the past 1 week. The pair was pretty much bearish. And then at level 3, which ended right there, we had this aggressive push to the downside. And then the dealer extends that low all the way to the very end of that week. And at that end of the week, we had some sort of pattern which came right at our perfect moment of timing. But when this was happening, when this situation was forming, look at what the TDI is saying, right? So this move here, even though it's lower than this, it's actually not real. This move here is not real, right? It's not real. The TDI is not falling for that. So what you get is a reversal. Actually, the TDI also getting to confirm a pattern, and the price also giving you some sort of debris formation, which came in perfect moment for us to take along, and we get our TP1 and our TP2 hit. Okay, now this is on 15 minutes. I want us to now look at another situation where the same is repeated on a higher time frame. So here is the thing. From what we can see or what we can tell is that the dealer has done, we get our peak right here. Okay, so here, this is our peak, and we do level 1. Okay, then we do level 2, and then we do level 3 right there. Then you have this aggressive push to the downside, a stop hunt and a pin to the low. But then from this moment here all the way down, you will notice the TDI swallowed the entire move and actually was able to confirm that this entire drop from here was actually a lie. So on Friday, New York session, we had a perfect reversal to the upside. Now, I would put those two trades here, one on CHF JPY and another one on Euro CHF. We took it right at this particular moment and we were able to squeeze the profits all the way up. Now, that means if you're able to now combine the TDI divergence with actually level 3 reversal, your accuracy improves significantly. All right. And so at this particular point in time, you want to actually train your mind to see how divergence happens on the price. So this is GBP and ZD, and GBP and ZD has been bearish, okay? But now you notice what is happening from this particular point here, right? This particular point here, the price is going down, but the TDI is actually saying no. I would consider this right here as my extreme because I don't want to consider this right here. I will take it from here, okay? From this moment right here going up. As the price is hitting low, the TDI is actually going up. I don't know which day it was exactly, but the price pushed higher and reversed to the upside. Okay, now here's the thing. I know I cannot explain everything in a small short video. I would want you to go back and look at your TDI at every point when the market is reversing and see how that divergence is formed and how it can help you to actually filter out wrong signals that the market is about to reverse. Now, there are several mistakes that people are making using the TDI for confirmation. And number one is actually taking TDI divergence alone as a signal. TDI divergence cannot be relied on as an entry signal. The market is the one to decide whether we have a signal or not. But then you're going to use the TDI as a confirmation tool. So a lot of beginners make this mistake. You assume because the TDI is showing divergence, it must reverse. No, it doesn't happen. You must also be able to ascertain those facts with what the price has done over the last couple of hours, couple of days, couple of weeks. Okay? So you must combine divergence with level counting. You must be able to tell, am I sitting at level 1 or level 2? Or am I at the level 3? So that I know I am looking for a stop hunt low or a stop hunt high. And then we start dropping. The other thing is session timing. If you get that divergence, but then you are still outside the wrong moment or you're trading outside the right time, you're still going to get caught up because the TDI itself cannot be relied upon. It has to be combined with other several factors that bring a strong confluence. All right. If you also ignore the stop hunt structure, if the dealer can show you clearly that they have been consolidating with no aggressive pushes and you're sitting at level 3, expect him to push down to grab money and then he can actually get to pull back. And this situation here confuses a lot of people. Once you see this consolidation, the market pulling back slowly and you start buying and then all of a sudden it sells on you, right? This is you ignoring the stop hunt structure. All right. Then the 50 EMA relationship. When you're getting that TDI divergence, usually you want to see the price coming all the way. When you're getting that reversal, the price is somewhere around here. And the TDI is also showing you some sort of divergence. Then you'll have the 5 and 13 cross happen somewhere around there and the price starts going up. All right. Most of the time, this situation will happen. And especially on 1 hour and 15 minutes. All right. So TDI is the confirmation, not the setup. And so you must be able to follow these rules for you to properly use the TDI divergence. Now, when is the TDI divergence most reliable? When do you know that when I see that divergence at this particular moment, that's a very strong and reliable confirmation? Number one is the end of level 3. If the dealer has been pushing down or pushing up, and you can count the 3 bursts of price, and you're sitting here, you can expect the dealer to bring the price back when you see the confirmation on the TDI. If he's been pushing the prices lower, and maybe you're sitting somewhere here with this particular sort of pattern and the TDI divergence, then you can expect that there is a high probability the price is going to push upside. The other thing is New York reversals. At the point the dealer pushes the market down or up during London session, most of the times New York session will come and reverse the price. When you look at the TDI, it will be telling you some sort of communication, telling you that at this particular point, this move is not true. We are going up. And so you're taking that at the right moment and you push the price back up with the dealer. You can also compare the divergence against major highs or major lows. Maybe if we are trading at the high of the month or at the low of the month and the dealer has created an extreme divergence on a lower time frame, maybe 1 hour or 4 hour, right? So you would expect, because this is a key point or is a key level in the market, the dealer will do what? Will reverse the price. So you're comparing what you're seeing on the TDI versus where the price is sitting at. And if you have that divergence on the TDI and what you have on the price, then tick. That means you have a high chance of winning that particular trade. Or you can also compare TDI with after compression zones or consolidation zones. So you're either going to get a breakout out of those consolidation zones, or you're either going to get a reversal from those particular price movements. Now, what we've just looked at right now is actually the moments when the dealer loves to deceive the traders most, because he knows that is the areas they are probably interacting with. For those people who are trading support and resistance, probably that's where they are most active. For anyone who is intending to probably grab some real quick profit for the day, probably those are the key levels they are looking at. Now, anything that looks obvious to the dealer, those are liquidity zones. Is where the people are putting their money, the retail market, in other words. All right. So these are the moments the dealer loves to deceive the traders most. So he fakes out, comes back, he does a lot of crazy things around those levels. And so divergence exposes that particular situation every time. If you're able now to identify and confirm those things with the TDI, hardly would you go wrong. Okay. All right then. So up to that particular moment, I think I've been able to explain everything there is about the TDI divergence. And if there is anything you feel I haven't been able to talk about, like I said earlier, you can of course drop that comment below and we will definitely look into it in the next video. All right, traders. So that's the TDI divergence explained within the BTMM method. If you master this single confirmation tool, then your reversals become clearer, all right? And your timing improves because you'll be able to see things happen in real time and you will be able to know whether it's your time to strike or not, okay? And you'll avoid getting caught in the dealer's traps because most of the time when the TDI confirms something, hardly will it be broken, especially if you're able to combine it properly. Okay, so if you want a full breakdown of entries, session timing, the stop hands, subscribe and comment below what topic you want me to look at next, and I'll be sure to make a video about it. All right, so take care of yourself. Thank you for watching this video. I'll catch you in the next one. Peace out.